Good afternoon, good morning, good evening, depending on your time zone and when you watch. Thank everyone for coming to our panel discussion titled The State of Biopharma, Navigating a Stormy Climate. On the heels of the publication of Locust Walk's 2022 second quarter report on global trends in biopharma transactions, we're joined by a great panel of experts to help us unpack the current trends in the industry. We have 1 hour allocated for the panel, including questions that we've prepared in advance, as well as questions received in advance from some of you, from the participants. If you have any questions that you would like the panelists to address, please submit them through the Q&A system. I will read out the most frequently asked questions and the ones that have the broadest applicability to the audience interspersed or at the end. If we do not have time to address your question, we'll follow up separately with our thoughts. We are also recording this session, and a playback on YouTube will be available shortly afterwards for attendees. I'm told that the last webinar we did had a whopping 700 people watching on YouTube. So now hundreds of people, it's like going viral biotech style. So just wanted you to be aware, if in case you can't join or you wanted to hear a point over again, or need a cure for insomnia. I'm also obligated to share that due to confidentiality obligations and other regulatory requirements, we are not going to address questions specific to any one company. And to be clear, that includes Jounce, and that includes Fulcrum. Rich and Esther have graciously agreed to join, but clearly they have obligations that we don't want them to violate. So just want to make sure that everything they say not only is off the record, but is generic in nature, unless they choose to specifically bring that answer to Jounce or to Fulcrum. So I want to make sure we get that out of the way. But they can, of course, disclaim as they want. This is also not legal advice, and it's also not an offer to buy or sell any security. As I said, everything we say is off the record, although it's going to be fairly widely available. So, quick summary. As many of you know, each quarter we put together at Locust Walk a key statistics and trends on both strategic transactions as well as capital markets financings. The second quarter report that we put together ties all this data together and includes a firsthand account of what's going on in the industry to try to analyze the deal landscape. So, as many of you know, it's been challenging, but there's been lots of implications of that, which we're going to cover today. There's been an effective freeze in new IPOs, and there's obviously been reduced valuations in the public markets, but private markets have still continued their similar pace. We have seen a recent uptick in valuations, which we'll also discuss, and the impact that's having on the public financing markets on the follow-ons, and then also, of course, the impacts for partnering in M&A as a financing vehicle and or an exit. So we're going to cover a lot of ground. We're going to focus it a bit more on public companies, but Andy will take a lot of the private questions, and Rich also is on the board of a private company, so he also has some generic, de-identified, I should say, insights that he can potentially share as well. So that's the backdrop. Let me introduce the panelists, and then we will dive right in. So start off with Esther. Thank you for joining, Esther. She joined Fulcrum in January of 2022 as the CFO, and she has nearly 20 years of experience in the life science sector, spanning equity research, investment banking, and strategic consulting. She's got the full package. She was previously a senior equity research analyst at UBS, covering small cap and mid cap biotech. She did similar things at Deutsche Bank and Oppenheimer. Before her career in equity research, she worked as an investment banker at places like Bank of America, E&Y Capital Advisors, and also as a pharmaceutical strategy consultant before that. She has degrees from Wesleyan and also an MBA from Wharton. So welcome, Esther.
Thank you.
Next, we got Rich Murray, who is CEO of Jounce Therapeutics. Thank you for joining. For those of you that don't know, Jounce is a clinical stage immunotherapy company developing therapies to enable the immune system to attack tumors. Rich brings to Jounce more than 2 decades of biologics R&D leadership and expertise, moving product candidates through development to commercialization, which is the ultimate goal for both startups as well as large pharma companies. He joined Jounce about 8 years ago from Merck, where he was SVP in biologics and vaccines. He was EVP and CSO at PDL Biopharma, where he actually was one of the guys that's on the management team of EOS Biotech that sold to PDL. And before that, he spent 10 years doing research in the staff of DNAX Research and also Schering-Plough Biopharma, which is now Merck Biologics, I guess full circle. So welcome, Rich. Thanks for joining.
Great. Thank you.
Last and not least, we have Andy Meyerson, who brings to Locust Walk, and as a regular on this discussion, experience from across the life science industry, including a legal background, investment banking background, working with venture capital, working with emerging companies. He joined Locust Walk in 2014 and is now a managing director working with companies across strategic transactions and capital markets fundraisings. Before Locust Walk, he had the unfortunate of being an associate at two different law firms, Gunderson Detmer and Wilkie Farr, and also was an investment banker at Credit Suisse before that. So Andy, welcome. And for those of you who don't know me, I'm Geoff Meyerson, CEO and co-founder, head janitor at Locust Walk. But I'll leave it at that. So with introductions out of the way, we are ready to tackle the topic. So just diving right in, there's been a fair bit of negative market sentiment in 2022, including in this quarter, although again, there has been somewhat of an uptick in the last, call it 4 to 6 weeks. There's still roughly 200 companies, without getting specific, trading at or below cash. So, depending on what day of the week, it might be different. But the private financing volume is down in the first half compared to the first half of 21, not surprisingly, but the public IPO market has been non-existent. I think there's been 7 or 8 weeks now where there's been no or only one IPO, and only 7 total for the year. So follow-ons are picking up, but we're seeing more of that being raised in the form of pipes as opposed to follow-on. So I'm going to ask a general open-ended question for each of you, and feel free to opine as you see fit, but everyone wants to know, and I'll start with this. Have we hit the bottom? Are we on the upswing? Or is there another down leg to come? And I'm curious if you've heard anything, either from talking to investors or partners, and so feel free to opine broadly. So Esther, why don't we start with you?
Great. Let me consult my crystal ball here. I think leaving sort of broader macro factors aside, I think this is definitely an environment where investors are more likely to be stock picking versus taking a basket investment approach to biotech, which is, I think, some of the dynamics you're saying that you referred to, which is generalists sort of, leaving the sector and all of those kind of playing out. And I think, have we hit the bottom? I don't know, quite honestly. I mean, things are, there was, when we started the year, there was a lot of sentiment around if things, may be bad for a little while, but it'll definitely improve in the second half, and we're just entering the second half. So lots to see. But I do think that companies that provide an opportunity to mitigate binary risk, i.e. have more than one asset in development or and have more flexibility with capital deployment, whether it's deploying or pulling back from deployment, are likely to be more attractive. And then we'll just have to kind of watch what the large caps do and see how that changes sentiment around mid-cap biotech.
Rich, what do you think?
Yeah, sure. I can maybe just add a bit to Esther's statements. I think the calculations have been done from kind of more the analytical minds that look at these periods that happen over time in biotech. So you can kind of try to triangulate into the numbers and the situations and so forth, and really estimate what the duration of where we are now, or perhaps even lower, might be before there is a meaningful uptick. So aside from that kind of analytical approach, I do think there is, Esther used the word sentiment. I do think there is a sentiment that, takes off. Things are really bad until they're not. And usually the spark of that is, comes in the form of some, exciting clinical results from a variety of different areas, different sectors. So I think the combination of, money to be put to work, the, opportunity of something really catching kind of everyone's attention creates a scenario that helps lift us out of that. So that's just an addition, I think, to what I would otherwise agree with what Esther said.
Andy, do you have a crystal ball you can share?
I wish I did. I wish I could have an almanac from Back to the Future. But I think fundamentally it's been weird, right? Because there's nothing that's really happened in biotech that's different this year from last year, fundamentally, right? And so everything that's happening is in many ways a function of macro issues that are unfortunately then getting taken out biotech in some respects. I think if we hit a bottom, I don't know, but one thing we have seen is that there's at least been more of a stabilization in how the markets are operating. We've gone from a situation in January, February where good data made your stock drop to now, good data, your stock goes up. And so that automatically is an improvement from where we are. Are things going to continue to go down? Who knows? But I think fundamentally, and getting to what Esther was saying as well, it's all about for public companies now. What are you doing to maximize value in the short term? How are you leveraging your cash? And what is it that you're deploying it against in order to make it clear what it is you're going to look like on the other side of this, whenever that ends up being.
Mm-hmm.
So it's interesting that typically biotech has been somewhat uncorrelated with the rest of the market, where if you have clinical development, it's fairly idiosyncratic. It's not going to be something you'll see in the market because there's not a correlation between the two, but we're seeing a high correlation right now between biotech and all other risk assets. The interesting thing, I never thought I would say this on a webinar, but I looked at the price of Bitcoin and Ethereum, and that's actually up a lot the last couple of weeks. And so there might be a kind of a slight, not risk on, but a rebounding of all risk assets. And so I don't know if we want to ascribe too much credence to this change in the near term with something biotech fundamental versus more broad macro market fundamental. So, it's just an interesting observation. I don't know what necessarily to make of that. My 2 cents, and I'm just going to throw it in there because when I get the floor, I can make these kind of calls, is that we still haven't hit the bottom. I still think that there's more pain, but I don't think it's going to be broad-based. I think the fact that we're seeing some companies with positive data get recognized and be able to raise capital means it'll be more of a stock pickers market than everything going down. So I think there'll be more haves versus have-nots, and not everybody as a have-not. So that's my kind of nuanced change from the last quarter webinar where everything was in the dumps. But I do think there is some positivity around good data, but that's going to be required to get an uplift in your price, at least the next 6 months. Is that any reaction to that?
Yeah, Geoff, maybe I can make a comment to that. I think, there's been a bit of a trend that I think is, I don't want to call it unique, but is something that is interesting to observe, where there has been a pattern of, sell on the news because there was a build-up kind of to the news and it hits and people sell, even if the data looks pretty good. But what is interesting is that watching that pattern and then watching a slower build back rather than having data come out and things kind of really taking off like a rocket ship. So it may imply perhaps there's some desire to hold back on some of the losses that might be kind of embedded, as well as then seeing that data when it's now dropped and really building into a position that might be desirable because that product candidate looks reasonable. So an interesting kind of pattern, if you will, as to at least what we've been kind of observing from some of the kind of analytics.
Yeah, and I think just to add to what Rich said, I completely agree with you, Rich, in terms of some of the dynamics that played out in 2021 versus what we're seeing now. I think, there are a couple of things here, right, that I think are positive for the sector overall. Number one, there is still a lot of capital that can be deployed that's just sitting on the sidelines, waiting for that spark, or Rich, as you say, that those sort of broad catalysts that can then spark investment. But more importantly, to your point, Geoff, the biotech sector fundamentals remain strong as long as there is continued innovation and progress from bench to clinic, right? And we're seeing a lot of that, even with a lot of the medical conferences that have happened in the first half of the year, and hopefully the second half of the year too. So I think the broader macro factors like increasing interest rates and inflation are less likely to have as much of an impact on biotech as long as some of the data catalysts and the sentiment really changes.
Yeah, so on that, I think the generalists, it'll impact them. It won't impact the specialists. And so if there is positive data and the generalists see that there is money to be made, they might start to come back in. So I agree with you in general. I just think to be cautious about that because we need more than just specialist capital to support the stock prices of 800 biotech companies.
Totally agree.
So, Andy, is there anything you wanted to add, or can I move to the next?
On to the next one. Nothing,
Perfect. Okay.
important to
So a follow-up for Rich and for Esther about public company financings. And I mentioned this briefly in the opening that we're seeing companies have an ability to raise capital, whereas last quarter, even earlier in the second quarter, it was more challenging. That if you have good data, we're seeing an awful lot more pipes as opposed to follow-ons. I'm wondering if you can comment generally about that, just from conversations you've had with investors, and talk through a bit of the strategy around why do a pipe versus a follow-on, and how do companies think about that trade-off, and how do you see it changing over time? So Rich, why don't we start with you on this one?
Yeah, sure. So let me put in my first 2 cents of over the years, in terms of my background, maybe 30 years around so doing this. So I answer these kinds of questions from just that base of experience, not particular to the Jounce scenario. So I just want to make that point. I put that in terms of pipes, just kind of into the context of what are the relevant kind of tools in the toolbox for any given company and their situation. Get maybe to pipes in a little bit more specific in just a moment. But the key, of course, is really having that one slide where you've got your runway, you've got your time to your existing burn and where your catalysts live, and that captured in a simple way is really the key to it all. And then given the profile of the company, what becomes the way to ensure a further runway and longevity. So I guess that's kind of the first statement to make. But I do feel in a time where there has been this phenomenon of sell on the news and the dynamics look a little bit different. The idea of pipes and the ability to kind of come over the wall and see the under confidentiality and see what's emerging, makes sense that takes place a bit more often without the reliance on the data coming and then raising money off that. But I think again, it's just to me and to I think most CEOs kind of a one avenue that could be pursued versus raise off the clinical data. The business development comes into context to other assets that are partnerable. And, so all of it to me is, really understanding that runway, where your inflection points are, and what's the best choice for that given company's profile to raise more capital.
Yeah.
I was on mute. Go for it, Esther. I wanted to hear.
I was just going to say, so maybe I'll answer from a CFO perspective. You raise when you can, right? Not when you need to. So that's sort of the lens that, in that lens, whether it's a pipe or a follow-on, you're kind of looking at essentially what is it that you need to fund, and what does this funding get you to? As Rich said, how does that sort of fit into the lens of your runway? Really. And I think, and again, one of the dynamics that broadly has played out is data is being potentially being shared when it's not as mature as, typically in the past. So from an investor standpoint, one would expect to want to go to behind the scenes to, get a look under the hood and see if it, if there are additional diligence items that they can check off on their end. And I think that's some of the dynamic that you're seeing played out with the pipes. And quite frankly, from, and again, this is not a comment specific to Fulcrum, but just broadly, when you're looking at, taking a risk with potentially financing at a lower valuation versus taking a risk of, waiting to see if the stock will run up and then finance as a follow-on, I think it's a very delicate balance that you have to kind of think through. And again, it's in the context of runway and what your other options are.
Yeah, so we're going to talk about other options in a second. So that's an important segue. But I think one thing to think about with this, and Andy, after this, we're going to go to some earlier stage things. So I have you in reserve for that. The follow-on market right now is suffering significant discounts to get those deals done, including warrant coverage and otherwise. I think some of these pipes is, even if they're being priced at the market or similar, and it seems like it's a better deal. I think what I've heard, and I'm curious if you agree or not, that there's a de facto discount that you're getting, investors are getting if they do a pipe, because they're able to see data ahead of time. Presumably, if that's positive, that would have led to a stock lift after that data was released, and instead they're getting it at today's market price versus, to your point, Esther, paying the premium or taking that risk of the stock running. So is that true? Do you see it that way, that some of these pipes are building in de facto discounts because they get to see the data early?
Yeah, maybe I'll go first. I do think that's the case because they're getting to see the data early, and once you kind of get into the pipe situation, an investor can walk away from the data if they don't like it, right? So it does provide a lot of flexibility from an investor standpoint and when and if they want to step in, and typically valuations are more attractive in this market. Valuations have been more attractive pre-data versus post-data.
Right. Yeah, I would agree. Even with the fluctuations that can occur, and that we've been talking about earlier in the post-data scenario. But of course, there's more risk getting in early. The data tends to be a little bit more wobbly, if you will. But that has to be understood and kind of baked into the whole equation. One thing that maybe I'll mention, Geoff, it's a little bit maybe tangential to specifically the questions you're asking, but I think it really pays to ensure that management teams and boards have a very kind of active kind of dialogue as to where are we living now in the new kind of moment of valuations of companies, and therefore how do you look at when an investment might be made and the dilution that comes with that. Is that acceptable? Are there other alternative routes that get you kind of where you need to be? So I would maybe emphasize the point of the internal alignment within companies to be able to act quickly when the moment if and when the moment is there, and not necessitate the process of getting aligned, but rather kind of be proactive. Because I think Esther said it, when you can raise money, that's something you should do.
Yeah, makes total sense. And I think we also have to talk about how do you prioritize your portfolio and think about the implications of that on your strategy, especially when you're looking to raise more capital, when there has to be an investment thesis that's investable.
Mm-hmm.
So we'll table that for maybe about 5-10 minutes down the road. But I think the follow-up to this on the public side is how are the private companies doing, and what's investable these days? And if you're a private company, how should you be thinking about the market, especially in light of some of the struggles that public companies have? And if there are pipes being done, a lot of the typical venture investors might want to do a pipe in one of those companies trading at or below cash versus put that money into a private company. So it's not just crossovers that are impacted, but even typical venture capital has that option. So I guess I'll throw this one to you, Andy, is how should private companies be thinking about the market, about raising money, and how do you compete with a company that'll do a pipe on good terms?
Yeah, no, absolutely. And it's an interesting issue, right? And a lot of it depends on where you are as a private company, right? Are you a private company that if this was 6 months ago, or more like 9 months ago, you'd have been public already, right? You would have raised a crossover and you would have already gone out. That's a very different company from someone who's just getting started, raising an A, maybe starting to think about a B, although in many cases the B was the crossover when we got to the height. And what's really, I think, a dynamic that's in play here is a lot of companies raised money in 2021 that are private, while the market was conducive to raising privately. And those were at valuations that were expecting 2020 level public company comps. And so especially for these companies that are later on, their private valuations have a disconnect to the public company comps that they would compare it against originally when their crossovers were getting priced, or there'd be whatever it was, even if it wasn't technically a crossover. And so there's a discussion that still needs to happen amongst the company and the investors in terms of what is an actual fair value for that next raise, while still making sure from the company's perspective that you're not screwing things up when the market opens up again. They're sort of playing too much catch up over time because you took a significant down round. And so what it's really meant for later stage companies is either thinking through what's less money that I can take, how do I be hyper specific in my use of proceeds to get specific data that can come out that could be a catalyst for increased valuation, just like what Esther and Rick were saying is the case on the public side, or really thinking through, how supportive are my insiders? Is there something I can do from a BD perspective as a way to bring some non-dilutive cash in? If I haven't done that big pharma deal, should I put a bigger emphasis on that to help my profile look better for when I'm going to be public? And it really comes down to something I'll say at the beginning, which is all companies, whether public or private, have to look inward and say, what can I be doing now that makes me look stronger in 6 months, makes me look stronger in 12 months, if that's how long this is going to take. And it's going to be a combination of a whole host of things. Now, earlier stage companies, just to touch on that briefly, if we look at the activity in the private markets, the overall investing is way down, but if you look at where the dollars are going, they're all going into Series A's, right? So the level of activity is still high. It's just the total dollar numbers are down because A's aren't as big as crossovers. Average crossover is like getting close to $150 million or something, and A's are, sitting at 100 on the high end in a lot of cases. And so earlier stage companies have a very different perspective than from a corporate perspective, like early corporate versus mid to late stage corporate versus those companies that are private trying to get public. All the way through though, use of proceeds, how do I maximize value? If you're mid stage, you got to look forward. Did I execute correctly? That investors are going to trust me when I say this is my use of proceeds for.
So Andy, so then the follow-up question is, so figure out your right size use of proceeds, find a valuation that works. That's what I heard from you. And also think about BD to get non-dilutive capital and or reduce your burn. You didn't say the magic word of reverse merger, which I think there's been a lot of talk about from various different folks, including it not be a pure reverse, but more of a strategic reverse, where it's not about just taking over a public shell. It could be about combining 1 + 1 = 3, and that could catalyze cutting or right sizing, I should say. How do you think about that? And then I will turn that to Rich and Esther, obviously divorced from their current companies, just kind of generically how to think about that.
Yeah, no, absolutely. And it's something that companies need to be thinking about. And that falls into the bucket of what can I do today that makes me stronger in 6, 12, 18 months? Do I have enough to survive on my own as a public company, even if the markets do open up? Do I have the right number of assets in my pipeline? Am I generating enough? Do I have a nice news flow or anything else? And a lot of what we're seeing, and this is from both those later stage private companies and also some of those public companies, is a good way to do this is to be truly honest about what are my needs, what are my capabilities, what am I going to need in the future as I intend to grow towards whatever my longer term goals are. Is there a way that I could do something now that enables that to happen? And so that's almost exactly talking against straight up reverse mergers. I'm going to take the shell. There's a little bit of cash left. I'm now a public company. I'm going to do my thing and hope for the best, but at least in public. I think we've seen discouraging data on that front, and those companies have not been successful pursuing that path. But when you think about truly strategic M&A, that could be a public target with a private target. Well, even they're almost in some ways MOEs in some cases, or private. As we're looking at these, if you create a stronger company, that's a good thing, right? There's all the stuff you have to work through with management teams and people and everything else, and that's not to be discounted. But if you can strategically make a case for why two companies together are better, that then also becomes investable. So you can raise money and continue moving forward.
So makes sense. I mean, I guess, Esther, Rich, how would you think generically about, private to public mergers, again, outside of your own companies? I might say you're better off being private now as opposed to public. Just to take a devil's advocate here. What do you guys think about that?
Yeah, I can go first on that one. So maybe just one comment before we get to that particular question. there has been, as you know, I've seen, various analyses done, big inflows, and it may be driven by, a relatively small number, but very large funds being raised on the private side. So that kind of ratio of private to public funds has kind of tipped in that direction. So it's kind of an interesting phenomenon if in fact that, I don't know how much of that has all been deployed, but if in fact a lot of that is at the kind of the front end of innovation in, kind of a Series A context, is that kind of a reload phenomenon, waiting for whatever it's going to be, the 6, the 9, the 12 months that all of a sudden, there's a lot of, bright, shiny things for us in biotech. So that's kind of an interesting observation to kind of watch that happen and watch that progress. But then, I think outside of that, in the meantime, there are the later stage, perhaps crossover related zone, as well as the public companies, where again, Geoff, to your comment, I think, each company, given their circumstance, what are their strengths? What are their kind of relative weaknesses as to where they want to be on plan? Of course you have to look at all these things that are options to create more efficient value generation. And that again, I think is where it comes at the end of the day. Is that a business development deal, a straight up allowing a pipeline to be funded? Is that, throttling back so you really have shaped your assets? Is that the kind of merger context that you were describing? I think all of those have to be the kind of top of mind for management teams. And again, I would come back to the ability to have all those dialogues with management teams and their boards without kind of any elephant in the room in those discussions. And I think that makes the quickest path to efficient value generation.
Definitely agree. Esther, what do you think?
I think Andy and Rich covered it pretty much. Typically from my banking days, the way that I've seen most teams look at it is it's essentially more as a financial decision and a value creation decision. But I think even before that, you need to make an operational decision in terms of what can you get done as a private company versus a public company, and which context helps you get it done faster, more efficiently. So I think those are some of the dynamics broadly that teams need to think through and not just sort of rush to a financing, if you will.
So it's interesting that there's definitely pros and cons of being private or public. The balance was definitely all public up until the end of 21, where everyone would rather be public because the cost of capital was cheaper. And now in many cases, the cost of capital might even be more expensive. By definition, if you're trading below cash, you can't do that as a private company for the most part, absent a couple of exceptions. So the challenge, if you're going to do a BD deal and you're trading relatively modestly, is if you want a 200 million up front and your market cap's 200 million, I'm just throwing out simple numbers. The calculus for the big pharma company is, well, why don't I just buy you for 300 or 350 and I'll get the whole thing. I don't have to pay anything else downstream. Versus as a private company, that conversation doesn't happen because the private company doesn't have that same public scrutiny of the stock price every tick. So that's definitely a kind of against being public. But if you think about a company that gets public and has positive data in the last 6 months, that data was not reflected positively in the stock price. But if that does get reflected well, you could see an updraft and then an M&A premium on top of that, which could lead to even more value creation than if you didn't have that bogey on you. So there's no clear answer, which I think is interesting. To your point, I think it was, both of you basically said it's kind of a combination of your capital requirements. Can you execute more efficiently publicly or privately? And sometimes doing a merger is just a catalyst to make tough decisions where it's hard to do that absent that type of a transaction. But with it, okay, both sides are cutting and therefore it feels like you can get more synergies. Is that fair? Anything further, Andy, or related?
I think that pretty much covers it. I think the biggest thing is you have to leave with the strategy. From a corporate development perspective, is there any reason to do this deal? And then you can take a step back and say, okay, financially, can we get this done in a way that makes sense? Because if you start with the financial implications of it, it may look like a good thing to do, but then you emerge and you go, well, now what? Because the technologies aren't really conducive to each other. There's not any real pipeline synergies. And, everything's funded, that's great, but is that really enough to build value? And so as we're having these conversations, it's really been starting and ending with, why are we doing this? What is the goal? If it's just a financing mechanism, are we sure that this is the right way to go to get that done? And then not only that, okay, what do we look like on the back end of this, and how do we plan for the future with that pro forma? I'd say that you raised the point about market caps and how does that impact BD deals. We're having that conversation a ton, as you can imagine right now, especially as you look at comps from the last couple of years that show relatively high upfront for certain technologies. And it's been an interesting conversation. I think the farmers are somewhere in between, and it comes down to pretty much something that Esther said, which is, what is your current situation? How easy is it for you to say no? Do you have the cash to get through a data inflection or something else? And how firm can you be when someone raises the question, what if I submit a bid?
So actually, that's a great segue, Andy, to the next question, which you partially answered, but I'll ask it anyways. So thus far,
hey Geoff, could I make maybe one comment? Just to provide a little bit of perspective to what Andy mentioned. I mean, I think the pipeline synergies is important in all of these kind of discussions, where if synergy means, very connected and very like kinds of approaches, I mean, that's kind of one way to do it. But there's also, some element of kind of balance and diversity in here. And just to put an example on it, if you're, a company in the autoimmune space, just to make an example, and you're going after kind of a large market opportunity, there's a lot of heavy lift that might be involved with that, but a big kind of, pot of gold if you get there. Is there a balancing act to something that has a more, kind of precision targeted element to it in the autoimmune space? So for me, when anybody's talking about pipeline synergy, it's also kind of a strategy and not just synergy, meaning everything is alike.
Right, you're absolutely right. And it's really coming down to, are there two modalities that maybe fit in well together?
Yeah.
Or is there a way to, get a right mix of the big indications and the small ones? You have, easy ones and hard ones, and sort of a whole mix of a way to continue to support the stock if for some reason one of the big shots doesn't work. And so I completely agree with everything you're saying. Synergy is really, when I say that word, it's more, does this make sense together?
So in the spirit of not being too much of a downer, I'll try to position this question in the nicest possible way. But in 2022, we've seen more layoffs this year than we've seen in many years. I'll just frame it like that. Company reorganizations in small and mid-sized biotech. One of the questions from the audience is, there are too many biotech companies. Things that I said before is, I think there needs to be 50 to 100 companies that consolidate. We're maybe 20, 30% of the way there. But 6 months ago, I think people, when the new year turned, companies were thinking about, well, 2022 is going to be great. We're going to put 21 behind us, and we're going to be off to the races. And unfortunately, the exact opposite happened, where we actually accelerated off the cliff. And I think a lot of companies were not ready for it. And some were ahead of the curve, others were not. At this point, I imagine every company at the board level and management level is thinking about their burn, the programs where they're investing in. And I guess this is a generic question, again, not for Jounce or Fulcrum specifically, but my take is that if you could make it through your data with room to spare, you might not be cutting as deeply, because then you can raise money on the other side. But if you're funding a whole bunch of programs and you're not going to get through enough value inflection points, you're probably going to have to cut programs and or people. And so does that framework make sense? Or how should we be thinking about right sizing of some of these companies? Yes, it's easier to do in the context of a merger, but most companies are not going to merge. So again, taking Jounce and Fulcrum aside, how do you think about that type of a decision?
Maybe Rich, I don't know if you want to go, or that's a difficult question, but I guess I'll take it first and turn it over to Rich. Look, I think prioritizing spend towards goals and catalysts that are more likely to create value and a positive response from the public markets should be, a key focus for management teams, right? And whether that's sort of, cutting back on people spend or prioritizing between assets based on competitive dynamics, regulatory timelines, funding needs, or pulling back on select research projects, right? Everything should be on the table as we're kind of looking at this market. And I think, it should be from a strategy perspective, right? Lay out the strategy, prioritize within that strategy, and then figure out what you can do to get yourself there, whether that's, the next data catalyst or whether that's, a couple of data catalysts down. So maybe with that, I'll turn it over to Rich.
Yeah, I think it's a difficult topic, but I think it falls in line when the markets are like what we're seeing. But again, I think the fundamental core, I think, of many of these questions and discussions, Geoff, is where do you see the opportunity for for value generation, and do you have a track record of that in any way? So the ability, I think, number one, for everybody to kind of throttle it back a little bit without major catastrophe is probably within the domain of many companies. But then when you come to kind of the pecking order of options that any given company might have, again, coming back to what's that runway and where do the catalysts happen, I think start to spell out the kind of strategy to tactics of what you have to do to get there. And we all just have that responsibility of ensuring that, we've got the ability to get a clinical trial started and get that clinical trial finished. And we all want to create a nice, nice runway on the other side of that. So that's what we're all shooting for. The ability to do that, again, comes back to what's kind of in the toolbox for any given company and their strengths. One thing, maybe I'll take it in a slightly different direction, Geoff, is I do think that in companies of biotech size, in terms of kind of mid caps, the ability to engage the culture, to be transparent about what you can say, also very clear about what you can't say, and really ensure that the flag's planted that what we're all after is creating recognizable and great benefit for patients that need it. And so maintaining that kind of culture and being kind of transparent about what situations are to the degree possible by management teams, I think also adds a lot to this, because none of us want to be in any company, no matter what sector of the business they're in. Nobody wants to be in a place where a lot of energy is kind of bouncing off the walls and not really focused on what needs to be done. So there's an internal element of this that I think is tied to the company culture and communication and done in the right way, that I think is also really important. And it just speaks to, can you efficiently get to your inflection point?
I think something that's interesting is every company's situation is different, right? There's very few that are exactly the same, and every company has to do what's best for that company.
Right.
And getting back to something we were talking about earlier, as you're sitting there and assessing what are my needs, what's going to enable me to be stronger in the future, and making hard decisions around the allocation of dollars, programs, et cetera. As some companies may make the decision that we have to let some people go, particularly, it's tend to be concentrated in early research, right? Because that's not as immediately value producing. There also are that whole slew of companies that are right now incredibly focused on early research. And it creates an opportunity for those companies to maybe get access to talent that they didn't have otherwise.
Mm-hmm.
And it's a part of the market where, we have seen Series A's be able to get done, and companies be in a position to be able to hire, and public companies are hiring too, right? It's not just the privates that are doing it. And so it's it's an interesting dynamic because talent has always been an issue. Either you can't find it, or there's not enough of it, or whatever it is. And so now there's a circumstance where talent could be available. It's just you got to think long and hard before you take on this bet.
So one thing to point out is that this is not just a public company phenomenon. Private companies have to do the exact same resource allocation decisions to get through their next value creating milestone to avoid having to bridge, which obviously has implications on value and value split between investors and management. So everything that was just said, I do think is pretty broadly applicable. So I guess then the follow-up question though is, business development is one way of financing a company. We are seeing more companies turn to business development, both public as well as private, where before it was all about equity. We mentioned that in the last quarter's update, but we're seeing more and more of that, at least within Locust Walk. I'm curious, Andy, if you could comment on that. And then specifically, you made the comment, Andy, about early stage research not being real value creating, which generally the market agrees with that. It isn't, unless that could lead to collaborations with bigger companies that could end up paying for your entire or most of your research apparatus. So
right.
help us think about the strategy on BD relative to value creation and relative to what you just shared.
Yeah, no, absolutely. So when it comes to BD, which is essentially selling assets versus selling equity, right? It's not,
Right.
Rights to an asset as opposed to an asset sale. It's one thing that companies always have to be thinking of is, what do I look like if I do this deal, right? Did I sell the most value creating assets that I have? Can I exist as an independent company? Am I setting myself back 5 years if I sell these one or two assets? How do I make sure I'm not hurting myself too much while doing a BD? Just like a discussion you have to have around dilution on the equity front. Am I diluting myself so much that I'm destroying value within my own company in a way that's not going to be beneficial? The discussion that ends up happening with big pharma, because right now there's a lot of choice, right? As everybody turns to BD, the partners have a greater selection opportunity, including working with companies who previously didn't want to work with them, right? All their assets were fully owned, they're getting financed, they'll need to do a deal. Now suddenly those companies are looking to do a deal, and then pharma's having their pick. It really puts an emphasis on what is it that you want to go to the marketplace with. What are you saying is available or not available, and why? Why are you doing this deal? It's just for raising capital. That has certain implications. It's again towards, how do I build a stronger company? That has different implications for the type of deal that you do. It's really being able to articulate to the counterparties and also keeping an open mind as to who those counterparties should be. Not every deal has to happen with a big pharma. There are other ways of accomplishing your goals and thinking through, what are we actually trying to do?
Yeah, maybe I'd add to that. Sorry, go ahead, Geoff.
Passing the baton to you, so go for it.
Yeah, maybe just to add to that, I agree. I think you can't look at it as just a financing vehicle in terms of being able to do deals. But we were discussing the earlier research kinds of work, and then there's clinical stage, and there are different sweet spots, of course, where you have a time to clinic versus if you're in that close zone, there's changes over time. But any asset that might be sensible for partnering, maybe I will just wait for the clinical data, and that might mean paying more. So there's the kind of trajectories of ups and downs as to what you're partnering in and when. I do think it's also worth adding to that equation just the belief that your partner is really in it with you, and it isn't just the upfront you're getting, but really, that helps. That adds to the bank account. But really, what matters is that program like taking off, and then you really hit the milestones, royalties, and depending on what kind of deal it is. So the belief that that's going to be taken forward in a way that the company itself would like to do.
Yeah, so I think a good anecdote on that, Rich, is we were talking to a company, earlier stage company. They did a crossover, thought they were going to get to go public, and they raised the question about, hey, we want to sell one of our 2 early stage assets, preclinical. what is it we should do? And as we were looking at it, we're seeing, well, why are you doing this deal? And it's just to relieve cash burn. Selling one or both assets doesn't actually accomplish your goal.
Right.
Because sure, you got off the books, but then, what happens in 6 months? And as we were talking through the situation with them, it became clear, to your point, what those assets were is they were validation of their platform, even though they weren't quite at an IND yet. And it allows you to have a different type of conversation with potential partners around, yes, this asset's going to be something which is available, but it's going to be the foundation of a different type of deal. That's going to focus on our platform, allow us to leverage a research organization, allow us to do what we need to do to continue to grow as a company. And being open-minded about what you have and how you can leverage it is going to be an important thing. And to be also confident in yourselves and having confidence that your team knows what they're doing. You can execute against a partnership if you haven't done one, or you can execute against another one if you already have one or two. And really being honest in terms of, what do I really need? And then asking for that.
Yeah, being proactive. If you don't ask for it, you won't get it. And you have to know what you want. Is it offsetting burn? Is it capabilities, dollars, et cetera? So we're running low on time. I have a couple more topics that just wanted to capture. So relative to M&A, I think that's been a big discussion on both the sell side and the buy side. And Andy, obviously, you can comment from a different perch, but both the companies that Rich and Esther are from are, everyone's always a target and everyone's always a buyer. So I don't think there's anything specific, to your companies, but for companies in your situation or even a private company, how should they be thinking about, their sell side options around maximizing value? Because there will and there needs to be more consolidation. At the same time, how do you think about buying and what you would look for, again, in the abstract, not about Jounce, not about Fulcrum, but to the extent you could share the mindset of a CEO, CFO as a buyer or a seller, that would be helpful. And obviously, Andy, you should chime in with your views. So Esther, you want to kick this one off?
Sure. So I think maybe I'll talk about the buyer perspective first, especially for companies that are in this mid-cap sector looking for assets to buy. It's typically tends to be earlier stage and typically tends to be something that can, resource the pipeline, right? And in that context, you're basically looking for, how does this fit into the broader strategy, and where does it fit in with the rest of the pipeline? And then thirdly, how much capital do we need to deploy here in addition to whatever we're paying to bring it in, right? Like having a clear path to not just adding it to getting it to the next catalyst, but how does it inform the rest of the development program, I think is important. The other thing that I would also look at, is really look at how the competitive pipeline could evolve over the time when you're developing your own asset, whether that's in-house or, in-licensed or what have you. So I think those are some of the, big picture guideposts as a CFO that I would kind of look at to make a decision on whether to bring an asset in. In terms of, whether you're, whether you want to sell an asset or out-license an asset, that again, goes back to strategy. But from a CFO standpoint, you want to be thinking about not just kind of financially, where are you? What is the value creation by, with the cash flow streams that you're likely to get, but what can you do with the asset that a partner may be able to do faster, better, cheaper, right? So that's the framework that I would recommend.
Mm-hmm. Helpful. Rich, any thoughts?
Yeah, I think, the starting point maybe for a comment is the strategy kind of put in place by any given company. So if you're, just to put an example out there, I'm kind of making it up as we go here, but the idea that there's, a new scientifically very credible approach, but it happens to be an Alzheimer's disease. I mean, that's a long path and big stretches of, interval and spend to value generation points. Of course, if you get there, we all know what the rewards of that might be. So a company going down that avenue might be thinking a little bit differently than if you're, in this very targeted, population of individuals, and you've got some kind of predictive biomarker. So I think, that obviously needs to be in the minds of the management teams and the boards as to, is a partnership or an eventual, M&A for the company taking on one of these really big things, that you're going to look at that differently. On kind of the other side for biotechs who are looking to bring something in, obviously, again, depending on your company strategy, you got to move quick if you find that diamond in the rough. If you're looking at something that is, so clear and so obvious and so attractive, it's very hard to compete on that. One card to play on that, trying to compete, is the value sharing of what happens, but clearly the cachet of a small asset in a small company working with a big pharma carries a lot of weight for that small company. So I think the ability to be able to, if you're on the hunt for something that would be synergistic in the pipeline, the way we had that discussion, Andy, the ability to really have that resource so you can find it and move quickly, I think is really important. If you don't have that, it's kind of unlikely you're going to get it, just because of the competition for exciting programs.
So one quick comment, Andy, I'll let you finish off and then I'll wrap up. But that's exactly right, Rich. In our experience, sometimes being able to get liquidity for private companies where they might be long in the tooth, investors have been there for a while, could be an attractive option versus an M&A or a license deal with a big pharma might not actually accomplish the investor's objectives. So if you move fast, you can outmaneuver a bigger company,
right.
And especially with that liquidity within 6 months, after a lockup period, could be a very attractive option if that's the goal of the investors in that company.
Mm-hmm.
I think it's pretty straightforward. If you're a public company and you buy something, you have to be able to explain it. Why did you do this? Because investors have to get behind it. If you want to get any kind of appreciation off of it, and if you want to raise off of it anything, you have to be able to explain the story. If you're a public company and you're the seller, you have to justify the value. Why is this a good deal? Why should stockholders say yes? If you're a private company buying, there's not a whole lot you have to do because you're private and the board is the investors anyway, and everybody's pretty much aligned. But if you're selling, it's then coming down to, from my investors, is this going to meet their return profile? Which is something that Geoff was getting at. Are people looking to get some measure of liquidity? Is there a certain multiple that they were targeting before they actually wanted to sell this thing when they were underwriting the deal? And as long as those are getting satisfied, it's likely you can have the deal move forward. Obviously, weighing it against future dilution to reach additional catalysts to increase value, et cetera, et cetera, et cetera. But I think fundamentally, at a high level, those are the one or two questions that have to get asked depending on which side of the table you are versus public versus private.
Awesome. Well, can't thank all three of you enough for getting on and taking the fire. We are out of time now, but appreciate everyone else joining us as well. As a reminder, a link to the YouTube recording will be sent out via email to everyone who registers. You can also visit the Locust Walk website to download the Q2 report, Global Trends in Biopharma Transactions. So thanks to everyone. Enjoy the rest of your summers, and we look forward to seeing you in person hopefully soon.